Welcome back, everyone. Today, I decided to share my view about the oil market. And while it's not revolutionary or completely unique or completely out there thinking, it is kind of how I'm reading things and thinking about the oil market and really a number of commodities out there, just kind of where I see us being within the cycle. And so today is oil, but I think it applies to more than just this market. As for is my view consensus or contrarian, I don't really care. I don't really know because I looked at things independently and this is the conclusion I came to. And so, you know, it could be right, could be wrong, but it's my own thinking, and so that's where I am. Now, when it comes to oil, I think the inflation question of like what will inflation be is a big question, and I think that that mainly shows up in the back of the curve, and I'll get to more of that later, but I think that is a long-term question along with the growth in demand in the very short term. But I do kind of think the point is relevant that oil isn't particularly rare. And while it's possible there may be short-term capacity constraints, I think in the longer term, you really need to look at what would the cost of production be because, or at least the incentive cost, because you have a lot of regions that could grow or could produce more oil than they're producing as long as they can make money there. Now I want to start with a point on the bull side. I don't think oil's dying. I think there will be growth, and I recognize that there will be a lot of capex needed to keep production where it is, and even more needed to grow it. And I think if you look at history, if you look at when new forms of energy come along and what the implications of that are, well, really, the old ones don't decline nearly as much as you'd think, and I think that'll be true for oil, especially because of all the other use cases for it. So the big question becomes what price of oil is needed to get more production? And I think the beginning of the answer there is to look at the cost curve. And you look at, okay, well, what's the break-even price? Okay, for 30, 40, 50, 60 for the higher cost producers. Oil sounds are a bit different, but have a bit different dynamics at work there too. But for the most part, $60, $70 gets you more oil. And so the question then becomes, where are the costs going? Are the costs going up or down? And how much more oil is enough more oil? And so let's say I were predicting oil to decline in demand. Well, then the 50s is probably the good price, maybe low 60s. Now, if I thought oil's growth was going to go parabolic or exponential or whatever you want to say, okay, I think the 90s or 100s, maybe 80s could handle that. No, probably 90s or 100s could handle that. But the question is oil growth going to go to the moon, or will it just kind of continue to grow? Because if it's just going to kind of continue to grow, well then you probably don't need $100 oil. You probably don't need $90 oil. But the question becomes, in the short term, what's the price? And in the longer term, what is the price that kind of gets enough stuff rolling? Now let's rewind a little bit back to 2015 when this was the cost curve. And as you can see, for the most part, costs were higher in 2015. Now, why is this? Well, I won't pretend to know every single reason. I do know that technology has been deflationary. I know that rigs now are much more efficient than they were then. And I know that some, after going through a bust, there's some cost saving initiatives. Now, can there be more inflation in the future? Absolutely. And that could come from a number of different directions. But over the past, well, sorry, not exactly over the past 4 years or 6 years, but from 2015 to 2019, costs went down. And the implications of that are that at the same price, companies can have bigger margin. So if you're looking back at, okay, where was the price in the past? Okay, you can reduce that for the same incentivizing of investment. Now the curve is rather vague looking at it, but I think that you can see most of the costs are in the low to mid 60s. And I think that that over the longer term is a reasonable price for oil. And I think the futures curve agrees with the cost curve in that sense. And that to me looks reasonable. The thing is that while that may be a reasonable long-term price to assume based on the curve, it's also basically never going to happen. Why is this? Well, because when you consider the direction that the supply-demand dynamic is coming from, heading, and all sorts of stuff that happens in the middle, you have short-term stress on the upside and short-term stress on the downside. So that can mean $80 oil, it can mean $40 oil, depending on where the recent supply and demand dynamics and growth expectations are coming from. Because let's say, for whatever reason, supply overshoots demand. Let's say we get too much, maybe growth stops, maybe supply just goes wild for whatever reason because they decide, oh, we can make a lot of money at these prices. Whatever the reason, let's say we need an off switch. Well, where's that? Well, probably 40s, if not 30s, to really say, okay, stop the growth, stop everything. We need less oil. So that's kind of the bust regular downside. Of course, we can have some fights in the middle of a bust like we did last time, and oil can go far lower. We can also have some demand spikes and some issues that would take it much higher than what a reasonable upside would be. But the go button, if you will, is a bit more complicated in my opinion because it depends how much more oil you want. If you want just a little bit more, well then maybe in the 60s. If you want a lot more, as I kind of stated before, 70s, maybe 80s. Because when you look at $80 oil, assuming like adjusted for inflation, of course, at $80 oil, virtually all oil is economically producible. But now is where we normally run into the question of capacity constraint. Is it peak shale is basically the question. And there's a lot of opinions around that. There's a lot of people suggesting different facts. And the fact is, I doubt those people can say with certainty. I know I can't say with certainty what the answer is. But I do know with certainty that the US isn't the only place in the world that produces oil. And I can also tell you that there are multiple other places in the world that are growing oil production. So the question of is it peak shale may be very relevant, is very relevant. But peak can mean a lot of things. Maybe peak growth rate, peak growth, peak amount, and then what about the decline on the other side? So is it going to, like Christmas tree pattern? I don't know. But there's a lot of oil, a lot of places around the world that becomes economic at higher prices, and assuming that none of it will start showing up is a dangerous assumption. Not only that, but I think it's dangerous to assume that the US is the only place that can grow shale like crazy. And I think really looking at the futures curve with what I just said in mind kind of shows what I mean, in that if you look at the front few months, you see oil in the 70s, mid 70s. Why? Well, there's a short-term demand acceleration. Everything's reopening. We don't know how much more we're going to need in the short term. But as you go a year out, 2 years out, price is still just over 60 bucks. Why? Well, because in the longer term, it's hedging cost. So if the price was too high in the longer term, what you would have would be companies that would say, oh, wow, we can make a lot of money in a few years, sell the oil now and grow production. So as the back of the curve moves, you get a lot more impact in production than the front of the curve moving. Now, look, the back of the curve is moving up, which, you know, it a lot to do probably with inflation expectations and growth expectations. And so that is what's bullish, and that's probably what moves the equities a whole lot more than the front month is up 2% today, why are equities not on the moon type of thinking. So I don't really see, look, the equities may be cheap depending on how sustainable the cash flow is at relevant oil prices. But the oil itself, the price of the commodity, I don't really see any strong deviance with what the market is currently thinking. So if you're wondering why this video got all the dislikes and none of the likes, it might be because of this Twitter poll, which, while probably not the best sample size, is basically what I see on Twitter, in that I asked what is most likely of the four options you see below: higher in 6 months, higher in a year, lower in 6 months, lower in a year for the price of oil. And the results were, well, there's a number of oil bulls that are exposed to this question on Twitter. Now, my initial thinking would have been lower in 6 months, just because I'll explain it. And I had a very interesting conversation with a friend that I will share with you in a second. But I think lower in a year would be a second option. The problem is the further you go out, the more random things become. But it's very similar, 6 months to a year in something like an oil cycle. But that would have been my response. I set a reminder, so we'll check on it in 6 months and a year and see where oil is and see if wisdom of the crowds was right or not. So when I was discussing the poll with a friend, he said he thought that the most common answer should be higher in 6 months because the economy is normalized and then the price should go up because there will be more demand. And I said, well, wouldn't investments be made in advance? And so with expectations of the economy being higher or better and the price being higher, wouldn't money be more likely to be spent before that with that expectation? And the thinking was a little bit more elaborate than that, but the point is, if everyone's expecting something to be good, then, well, that's probably what everyone's expecting and what's kind of being priced in now. So really the price change is based on the delta, the change between what actually happens and expectations. Now he thought about it and he said, I don't know if I got him to fully agree or not, but he then said, but after what happened in the past, wouldn't they just wait for prices to be high enough for them to make money, to make the investments, and not just bet on the future? Which is solid logic. My rebuttal was then, you mean like over 70 bucks? Because realistically, if you look back at 2018, the price was mid 70s, high 70s, maybe, perhaps. Maybe costs are lower now. Maybe they're not. Maybe everything's a lie. We never know. But that was enough to get production going crazy, to get a lot of growth out of shale. Now, I know what everyone's going to say, which is, of course, that something along the lines of shale's a scam or a Ponzi scheme or something like that, because it was never profitable. There's rapid declines and all of that negative stuff, which a lot of it is very true and very accurate. It's running on a treadmill. But at the same time, let's say you're investing some capex. What type of project do you want? You want one that pays back very quickly, and that's kind of what it does. Now, the decline rate is very unfortunate in that it pays back very quickly and then it falls off a cliff in terms of production. So you would need, in order to keep up the growth, you would need constant incentive prices. But when you get them, in theory, supply can react very quickly and add a lot of production very quickly. So all that to say, maybe, but the main thing it means is a lot of volatility in price, potentially in both directions, and that is the risk. So in conclusion, on an inflation-adjusted basis, I think it would be more fair to call myself a bear than a bull when it comes to oil prices. But I would not at all be surprised to see $75 or $80 oil in the next month or two, perhaps, before the fall when prices may struggle, in my opinion, maybe into the winter. Again, once you go further out, it's harder to predict that type of thing. But overall, I'm not a bull longer term on prices. Now, I would like to add that I do think oil equities are generally not expensive. So if this view is wrong, if we get sustained $80 plus oil prices, well, then there may still be a lot of asymmetry in oil equities. The thing that I would caution people is last time when you looked at the bull market in oil, what was the story? Peak oil. There's not going to be enough of the stuff. Now, again, in the short term, that may happen again, and there may be all sorts of stories around ESG limiting, upping prices or limiting capacity or all sorts of stuff. But in terms of actual production capacity, I mean, the story is more, and then things could change, but the story is how much longer are we going to need growth in oil? And while I think that'll continue for the longer term, I think that there's a lot of production capacity that could keep up. And when companies are making a lot of money, they're not capital constrained. And so that's kind of my thinking on oil. I will respectfully agree or disagree with you, whichever. If you've done your own analysis and you think I'm completely wrong, that's absolutely fine, and you may be right. But that's just what I'm thinking, and I figured I would share it with you. So thanks for watching. And as always, remember, not investment advice, and feel free to tell me politely where I'm right, where I'm wrong in the comments. And until next time, I wish everyone the very best.